Welcome back. Quite a bit of news today. Weak producer price index following a weak CPI yesterday. Also, Federal Reserve meeting. We're going to take a look at a moment historically how the bond markets acted in the past with this type of scenario. First off, PPI, producer price index, negative 0.3% versus a prior report of 0.2. The core PPI, which excludes food and energy, which are more volatile components of the index, 0.0 versus a 0.1 prior report. PPI, and that was month over month. Year over year, 1.1 versus 2.3, big drop. Core PPI, year over year, 2.8 versus the prior 3.3. Again, yesterday, CPI was weaker than expected. It took the interest rate hike off the table, which is what we saw today. The Federal Reserve does not raise interest rates for the first time in 15 months. Now, here's CPI, which we saw yesterday in red, S&P 500 in blue. Generally speaking, when CPI goes up, it means the economy is strong, and that bodes well for stocks. We can see that CPI has really kind of run away where the stock market has begun to wane. Same type of pattern for PPI. PPI is in red. The stock market, S&P 500, is in blue. The PPI is really starting to fall now. Now we compare CPI versus PPI. CPI in red. Now CPI is Consumer Price Index. Those are the prices that we pay as a consumer. The PPI are the prices that the producers pay for raw materials in order to create, what we buy. So it's thought that if the PPI drops, it'll pull down the CPI. The blue area chart in the background is a comparison of the two, and it's going up, which means CPI is rising more than PPI. In other words, the prices for consumers are relatively higher than they are for the producers. We may expect lower consumer prices, hopefully, if this pattern does continue. Now, the discount window, which reflects the Federal Reserve interest rate, is shown here in blue. We've seen a massive hike in rates over the past 15 months or so, from near zero to currently 5.25. The red is the S&P 500. Again, generally speaking, when we see interest rates go up, it means we have a strong economy, and the economy can withhold or withstand these higher interest rates. Unfortunately, we've seen stocks weak over the past year despite rising interest rates. Now, in this particular scenario, interest rates are going up to combat higher inflation that's taking place, that's occurring not necessarily because of a very strong economy. Some parts of the economy are strong, some certainly are not. The interest rates are going up despite not such a strong economy. Now, to take a look historically, what this looks like, the discount window going back to 2014 is in blue, S&P 500 in red. Again, very strong correlation, despite a lack of strength in the economy. But very interesting, and this is what we really want to take a look at. 2008, we saw interest rates very high, around the 6.25% level. Remember, that's when the stock market 2007 was still very strong. The S&P 500 was up at the 1500 level. Notice that interest rates started to go down as the stock market started to fall as well. We are at a very big top on interest rates. Now, we don't know. There is some talk that the Federal Reserve may raise rates again in the next meeting in July. Maybe this is the end. But because we're so high, historically speaking, in the year 2000, 2007, we saw interest rates at 5-6% in this area. Does it mean they're going to go down? Does it mean the stock market's going to go down? Not necessarily. But this is the pattern. Usually when we get to these levels, that's usually a sign of a turn or a point of a turn. And again, here in red is the S&P 500. We're now at 5.25, but now we see the discount window is staying flat at the 5.25 level. The real question between now and the next Federal Reserve meeting in July, in another 6 weeks or so, is the next series of economic numbers. Does it support higher interest rates? Does it support perhaps interest rate cuts into the future if we see a lot of weakness? So like always, the Federal Reserve makes their decision based on the economic numbers we watch. So we're going to take a very close look at these numbers as they transpire to try to get a better gauge as far as which way interest rates are going. Now, with that said, I think it might be helpful to take a look at historically what the bond market looked like during this period of time. The last time we saw interest rates going up as stocks also were going up. Now, on the left-hand side of the chart, we see the white line, that's the 1-month T-bill. The red is the 1 year. The blue, light blue, is the 5-year. The purple line is the 10-year. Now, what the takeaway, and on our right-hand side, we see the corresponding S&P 500. Again, it was very strong in 2006, kind of like what we're seeing now. Now, at the time, we saw from June, July 2006, we saw interest rates going higher. We saw the T-bill surge above the shorter term, relatively longer term bonds, and we saw very much of an inversion in the yield curve. We go to 2007, we see a very strong T-bill. The reason why this is important is that T-bill is a signal as far as the near-term outlook, when interest rates are going to stop going up. When we see the white line, the 1-month T-bill strong like it is here, October 06, it means the expectation is the Federal Reserve is still going to raise interest rates. We go to August through December, and we start to see the T-bill go down. Now, specifically, this drop in the T-bill took place December 06. We see the T-bill waver. It jumped back up. We saw this pattern very recently. We saw with a 602 yield on the T-bill just last month. It went down. It went up to 602. In this case, it was 527, November of 06, and then fell back down. We start to see the T-bill waver. Fast forward, the T-bill is still strong going into March of 07. Let's fast forward to April through July of 07. Then we start to see the white line, the T-bill, drop. At that time, that was a signal that the Federal Reserve was coming to the end of its interest rate hikes. Notice that T-bill dropped from May through, let's say, June, July of 07. We'll take a look at what the stock market did. The stock market was very strong July of 07, a little bit of a delayed reaction. Next thing you know, August of 07, we start to see that very big sell-off in the stock markets. Next thing we know, we see a huge move down. August of 07, the white line, the T-bill. Notice the rest of the yields are now starting to come down too. The purple line again is a 10-year, the blue 5, red 1. This shows us now the long-term expectation for interest rates continues to go down. That means we're seeing signs that the economy is really in a lot of trouble. We can fast forward all the way through, let's say, December of 07, and then we know what happens in 2008. Notice the yellow line, the S&P 500 on the right-hand side starts to go down as well. Now, this is a lot of fun. We're going to compare left-hand chart, that's the blue chart, that's June of 2022, just last year. June 2022 is very important. That was the beginning of the inverted bond market that we're going to see in just a moment. Right-hand side is what the bond market looked like April 2006. The maturities are at the bottom. 1 month is all the way in the left-hand side, and then the 30-year long-term maturities on the right. Left-hand chart, the blue chart, notice 1 month T-bill almost at zero. When you see strong stock markets, it usually is accompanied by very low 1 month T-bills, usually almost near zero. Long-term maturities, like the 30-year, offers the highest yield. Okay, that's normal. That's what we would expect. April 06 on the right-hand chart, same situation. T-bills at a 4.6. still relatively low compared to the 30-year to 570. Left-hand chart will go to July of 2022, just last year, about a year ago, the beginning of the inverted bond markets. Right-hand chart, we go to May of 06, June of 06, and then we see a flattening of the yield curve. July of 06. Then we see the inversion. Looks pretty similar. Left-hand chart, we see the highest yield is offered on the that's a 6-month at a 298. We still have high yield on the 30-year to 3. Right-hand chart, the 4-month has a highest yield of 518. Already the 30-year starting to fall. Well, left-hand chart, we see here August, September, October. And notice what's happening. The yield, the highest yield, is shifting to the left. It's moving to the shorter term maturities. Now the highest yield is offered on the 6-month. Well, right-hand chart, we can see August of 06, September, same type of pattern. Not exactly, of course, but pretty similar. November 2022, the inversion continues. December 2022. Let's go to January 2023. Okay, let's go to January 2007. Okay, we see the highest yields on the shortest term maturities. February of this year, March. Now notice what happens. Let's go back to February for a second. February, highest yields on the 6-month. March, highest yield is now on the 4-month. April, the highest yield is on the 4-month. May, last month, highest yield is on the 3-month. Present day, June. Notice the 1 month, I should say, is starting to fall. On the right-hand side, we see February 07. The highest yields on the 1 month. April. Now the 4-month. All of a sudden, we see May of 07. The T-bill, the 1-month T-bill really starts to decline. And that really, I think, is the takeaway. We see this pattern where we have the inverted bond market and we have the highest yields on the 1 year, then the 6-month, then the 4-month, and the 3-month, and eventually the 1 month. When you see the highest yields like we did just 2 months ago, April of this year, on the very short-term maturities, and then you start to see the 1 month fall. We've spoken about this in some recent videos. That shows us that the expectations of Federal Reserve is now close to the end of the interest rate hikes, which is where I believe we are right now. Now, of course, economic numbers pending, July meeting, and anything else moving forward is left to be seen. But if history's any judge, if history's any guide, and we see the 1 month continue to fall, well, then we would logically expect to see the longer-term maturities begin to follow. And then it may repeat the pattern we saw earlier in 07 and even in the year 2000. But it's not, a guarantee. It's just a guide. We're just trying to, recognize patterns and similarities with what happened in the past. But again, today, weak PPI, yesterday, weak CPI, that gave the Federal Reserve enough license not to raise interest rates, which they did not, the first pause in 15 months. We have a lot of economic data in the next 6 weeks before the next Federal Reserve meeting. And we're going to watch the bond market because I think the bond market is going to give us a clue as far as what may transpire in the future. We hope this has been helpful. We look forward to seeing you back soon.